What if I told you that hidden within the pages of corporate tax instructions lie these powerful strategies? Strategies that could directly boost your business's cash flow and, importantly, protect it from some really costly penalties. Forget just paying your taxes. Today, we're diving deep into optimizing them. Our mission today is to really unpack the, let's say, intricacies of IRS Form 1120W instructions. We're focusing specifically on corporate estimated tax payments. We want to reveal some crucial insights, maybe some. That's exactly right. And that's what we're aiming for today. This isn't just about, ticking boxes for compliance. It's really about transforming what feels like a necessary obligation into a strategic lever, something for robust business health. Understanding these rules, it's a vital component of effective cash flow management. It allows corporations like yours to retain capital, avoid unnecessary costs that just erode profitability.
Okay, let's unpack this then. For our audience, many are well-informed business leaders, curious minds. The general rule of who pays estimated taxes might seem straightforward, but let's quickly recap that crucial $500 threshold because, like you said, it's often those rapidly scaling smaller businesses that kind of trip up on this one, even if they're otherwise really financially savvy.
Yeah.
So who exactly needs to be making these estimated tax payments? Yeah, that's an excellent place to start because, well, many established corporations are well aware the general rule is fundamental. A corporation generally has to make these estimated tax payments if it expects its income tax liability, that's after accounting for any credits it might have, to be $500 or more for the tax year. Now, okay, for a huge multinational corporation, $500 might seem like, well, practically nothing, a rounding error.
Hmm.
But for a growing small or medium-sized business, that $500 threshold is a really critical trigger. Think about startups, right? Many might have low or even no taxable income in their first year or two, but then maybe some unexpected growth happens, a successful product launch, a really profitable contract, and boom, they can quickly find themselves over that $500 mark. And if they don't anticipate this, if they don't start making those estimated payments, well, they'll face penalties when they file their annual return. It can completely blindside them. So yeah, this threshold often catches those newer or rapidly expanding businesses off guard.
That's a really good point. Easy to overlook when things are moving fast.
Exactly. And it's also important to clarify something. While our main focus today is Form 1120W for, General C corporations, other specific types of entities also have estimated tax obligations. They operate under similar principles generally, but have their own specific guidance. For instance, S corporations. They pass most income directly to shareholders, right? But they still might need to make estimated tax payments for certain entity-level taxes, things like passive investment income tax or built-in gains tax. They should really look at the instructions for Form 1120S. Similarly, you've got tax-exempt corporations, tax-exempt trusts, even domestic private foundations. They all have their own estimated tax responsibilities. They need to consult the instructions for their specific tax return, like Form 990-T for tax-exempt orgs, to figure out their precise payment amounts. So while the mechanics we'll talk about are broadly applicable, you always need to double-check the specific instructions for your entity type.
Got it. Always check the specifics for your situation. Okay, so once a business figures out, yes, we need to pay, the next crucial question is when. Is this like personal income tax? Where it's mostly an annual event, maybe some quarterly payments for freelancers, but generally one big deadline? Or is there a different rhythm for corporate tax?
Oh, it's definitely a different rhythm, and it's one that demands pretty consistent quarterly attention. Corporate estimated tax payments are structured to align with a business's ongoing income generation throughout the year. Makes sense, right? Generally, these installments are due by the 15th day of the 4th, 6th, 9th, and 12th months of the corporation's tax year. So for a standard calendar year corporation, that usually means April 15th, June 15th, September 15th, and December 15th. It's absolutely paramount for businesses to calendar these dates meticulously, maybe set multiple reminders, because missing them definitely has consequences. And here's a practical little rule, but one that's often overlooked. If any of these due dates falls on a Saturday, Sunday, or a legal holiday.
Ah, the weekend rule.
Exactly. The payment is automatically due on the next regular business day. It's a small shift, but sometimes it can catch people out. So building in a little buffer, staying organized. That's a key. We're talking about the discipline of financial forecasting here, not just, reactive payments when the deadline hits.
Right, proactive planning. And speaking of consequences, what happens if a business does miss a payment? Or maybe they underpay an installment? Are there stiff penalties for these kinds of oversights? Or can a company just sort of catch up later without any real issue?
Unfortunately, no. There are very real and often pretty substantial consequences. It's not something the IRS takes lightly at all. Corporations that either, fail to make their estimated tax payments when they're due, or if they significantly underpay the required amount for any period, they can face an underpayment penalty. And this isn't just like a slap on the wrist. These penalties are calculated based on the amount of the underpayment and the period it was outstanding. Interest accrues daily. Yeah, they can add up really quickly. And that directly impacts a business's bottom line, eroding capital that could have been used for growth, for operations, anything else, really. To figure out if a penalty is owed and to calculate its precise amount, the IRS uses Form 2220. That's the Underpayment of Estimated Tax by Corporations form. So look, it's not simply about settling your tax bill eventually. It's about paying the right amount at the right time to avoid these additional and frankly often entirely avoidable costs. Proactive planning really is the best defense against these penalties.
Okay, so the penalties for underpaying are clear and definitely unwelcome. But what about the flip side? What about the cautious business? Maybe one that, just to be safe, overpays its estimated taxes. Is that capital then just stuck with the government until the annual return gets filed? Potentially for months, because that seems like it would significantly impact a business's working capital, wouldn't it? This feels like where strategic cash flow management really gets interesting.
It absolutely does. And this is a critical opportunity that honestly many businesses overlook or maybe just aren't aware of. You don't necessarily have to wait until your annual return is filed and processed to get that cash back if you've significantly overpaid. There is indeed a quick refund opportunity, and it can be a really significant benefit to your cash flow, letting you reclaim that liquidity much, much sooner.
A quick refund. Okay, tell me more. How does that work?
Well, there are specific conditions you have to meet. The overpayment you're looking to get back has to be, substantial enough to qualify. Specifically, the amount of the overpayment needs to be at least 10% of your expected income tax liability for the year. And it also has to be at least $500.
Okay, 10% and $500. Both.
Both. Exactly. So it needs to be a material overpayment, not just a few bucks here or there. If your corporation meets these criteria, you can apply for this refund by filing Form 4466. That's the corporation application for quick refund of overpayment of estimated tax. Now, this form has a very precise filing window. You have to file it after the end of your tax year, but crucially on or before the 15th day of the fourth month after your year end. And here's a key timing detail that trips up a lot of businesses. You must file Form 4466 before the corporation files its annual income tax return. It's Form 1120.
Before the 1120.
Before. If you file your 1120 first, you've missed the boat on the quick refund for that overpayment. You'll have to wait for the regular processing of your return.
That's a critical distinction.
It really is. Yeah. Let's maybe paint a quick scenario. Imagine a tech startup, right? Growing fast. Unexpectedly lands a massive contract late in Q3. Profits shoot way beyond their initial estimates, so they dutifully increase their estimated payments for Q3 and Q4. Maybe they even overestimate a bit, just to be safe. Without Form 4466, that excess cash, that overpayment, might just sit with the IRS for, 6, maybe 9 months until their annual return is filed and processed. But using Form 4466, they could potentially get a substantial refund back in their hands in a matter of weeks.
Wow.
Yeah. Freeing up that capital for maybe crucial Q1 hiring or product development, or even just bridging a gap until new funding comes in. It can be a real lifesaver for agile businesses that need to react quickly to market opportunities or just manage their financial needs. It turns that tax overpayment back into a liquid asset, fast.
That is a powerful tool for liquidity. Definitely something businesses should be aware of. Okay, so now a business has figured out how much they owe, when it's due, maybe even how to get quick refunds. How do they actually send the money to the IRS? Are we still talking checks in the mail, or is it pretty much all digital now for corporations?
Yeah, for most corporations, it's overwhelmingly digital. And in many cases, it's actually legally required. The IRS mandates that most corporations electronically deposit all federal tax payments. That includes estimated taxes through electronic funds transfer, or EFT. This isn't really an option for the vast majority of businesses anymore. It's pretty much a non-negotiable mandate, designed for efficiency, security, you name it. The primary way to do this, and often the preferred method, is the Electronic Federal Tax Payment System. You'll hear it called EFTPS.
EFTPS, right?
Yeah. It's a free service provided directly by the Department of the Treasury. It's designed to make these electronic payments straightforward and secure. It's essentially your direct portal to the Treasury for payments.
Okay. EFTPS sounds like the main route. Are there any other options if for some reason a company doesn't want to use EFTPS directly?
There are. While EFTPS is, the IRS's preferred direct channel, it's not the only way to meet that electronic deposit requirement. If a corporation doesn't want to use EFTPS directly, maybe because of their internal accounting systems or workflow preferences, they do have alternatives. They can arrange for their tax professional or a financial institution, a payroll service, or, another trusted third party to make these electronic deposits on their behalf. This definitely offers convenience, especially for businesses that maybe outsource their payroll or tax compliance functions.
Hmm.
It's worth noting, though, while EFTPS itself is free, these third-party services, they typically charge fees for their convenience. So it's kind of a trade-off, right, between direct management and maybe the benefits of integrated services.
Fees versus convenience, the classic trade-off. Makes sense.
Now, one absolutely crucial detail, and this is for ensuring timely deposits, especially if you're using EFTPS directly, it's the cutoff time. This is where a lot of businesses can stumble. For deposits made through EFTPS to be considered on time, the corporation has to submit the deposit by 8 p.m. Eastern Time.
Oh.
The day before the deposit is due.
Wow. Okay, not the day of, the day before.
The day before, by 8 p.m. Eastern.
Okay.
Let that sink in for a second. It highlights the critical need for advanced planning, right? Scheduling your payments ahead of the actual due date. Building in that buffer to avoid last-minute panic or, worse, missed deadlines. And if you were using a third party, you need to be acutely aware that they might have different cutoff times, potentially even earlier cutoffs, sometimes by a full business day. So clear, proactive coordination with them is absolutely essential. Don't wait until the morning of the 15th to try and initiate a payment that really needed to be settled by 8 p.m. the night before.
That is a huge heads up. 8 p.m. Eastern the day before for EFTPS. Got it. But what if? Stuff happens. What if, despite your best planning, you miss that deadline, is all lost? Do you just eat the penalty?
Not necessarily. There is a critical backup option, sort of an emergency lever you can pull. It's the same-day wire payment through the Federal Tax Collection Service, or FTCS. This allows you to still make the deposit on time, even if you're really down to the wire on the actual due date. However, and this is a big however, you can't just decide to do this spontaneously on the morning of the 15th. The corporation needs to make arrangements with its financial institution ahead of time, way ahead of time, ideally, to ensure they can actually facilitate these same-day wire payments.
So you need to set it up with your bank first.
Yeah, exactly. Set up the appropriate accounts, the permissions, and you'll definitely want to check with your bank about their specific availability for this service, their own internal deadlines for processing wires, because they'll have those too, and of course, any associated costs. Because same-day wires can vary significantly in cost depending on the bank. While it's a potential lifesaver in a pinch, it's generally more expensive and, frankly, more administratively heavy than just using EFTPS on time. You can find more info, including a list of banks that offer this, over at irs.gov, same-day wire. But think of it like an emergency parachute, right? Not your everyday mode of transport.
Good analogy. Emergency use only. Plan A is EFTPS the day before. Okay, now let's shift gears slightly. What about foreign corporations? Do they follow the exact same electronic deposit rules, or are there special considerations for them, given their international nature? Yeah, foreign corporations do have some important distinctions, and it mostly hinges on whether they have a presence, like an office here in the U.S., that significantly impacts their payment options. So if a foreign corporation does maintain an office or a place of business in the United States, then yes, generally they are subject to the same electronic funds transfer requirements as domestic corporations. The rules for EFTPS, using third-party services, that same-day wire option, they all apply to them in pretty much the same way, which means they'll need a U.S. bank account and they have to stick to those electronic payment deadlines we talked about.
Okay, so presence in the U.S. means same rules apply. What about foreign corporations without a U.S. office?
Right, so for those foreign corporations without an office or place of business here, their options are considerably broader. The IRS acknowledges the practical challenges of international operations. They can still use EFTPS, but only if they happen to have a U.S. bank account. And many do, for various business reasons, so that makes it a viable option sometimes. Alternatively, they can arrange for their financial institution, wherever that may be, to submit a same-day payment on their behalf. This often happens through a master account held by a large international bank, or they can work with what's called a qualified intermediary, maybe a U.S. tax professional, a payroll service, or another trusted third party to make a deposit for them, again, often using that third party's master account with the Treasury. This offers a lot more flexibility for international entities that might not have a direct U.S. banking presence or, detailed knowledge of the IRS payment systems.
That makes sense. More flexibility for those operating entirely outside the U.S.
Exactly. And here's where a truly unique exception comes in, specifically for this scenario, foreign core. without a U.S. office. They actually have the option to pay their estimated tax due by check or money order.
Really? A check?
Yes. It's a significant deviation from the electronic mandate for almost everyone else. It underscores the IRS's effort to accommodate these international entities without that physical U.S. footprint. Now, these payments, they have to be made payable to the United States Treasury. And for proper crediting, this is crucial. They absolutely must include specific identifying information right there on the check or money order. They need the Foreign Corporation's Employer Identification Number, EIN. The phrase Form 1120F or 1120 FSC, if that applies, estimated tax payment. And the specific tax period the payment is for, like, 2024 estimated tax agencies.
Yeah.
Without all that info, the payment might get lost in the system or misapplied. And these checks get mailed to a specific address: Internal Revenue Service Center, P.O. Box 40910 in Ogden, UT 84409. So yeah, this manual option provides a vital fallback for those specific foreign entities operating remotely.
Fascinating how specific the rules get depending on the situation. Okay, this is where things get really interesting, I think. We've covered the foundations: who pays, when, how, the consequences. Now let's pivot to the real strategic plays. This isn't just about compliance anymore. It's about smart financial strategy. Turning these payments into an advantage, what are some of the maybe lesser known but truly powerful methods that can turn estimated tax payments from just a burden into a significant cash flow advantage for a corporation?
Absolutely. And this is where those IRS instructions, which, let's be honest, can seem pretty dry sometimes.
Understatement of the year.
Huh? Right. But they actually become a roadmap for strategic financial stewardship. The instructions for Form 1120W contain several quite sophisticated methods. These methods allow businesses to actively manage and adjust their payments based on their actual income rather than being locked into rigid upfront estimates. This is key for preventing overpayments, minimizing those nasty underpayment penalties, and ultimately keeping more cash flowing within the business throughout the year. It's all about being proactive and agile, not just reactive.
Okay, so let's say a business's income changes significantly during the year. Maybe they have a surprisingly fantastic quarter, just killing it. Or perhaps things slow down more than they initially expected. What should they do? Do they just keep paying the same amount based on their initial guess, crossing their fingers and hoping it all works out?
No, definitely not. And that will be a huge missed opportunity, or worse, just a recipe for penalties later on. If, after you've figured out and maybe deposited your initial estimated tax installments, you find that your actual tax liability for the year is going to be significantly more or significantly less than what you originally estimated, the corporation should refigure its required installments for the remaining periods. This isn't just a suggestion. It's really a critical step in managing your tax obligations optimally, dynamically. For instance, if you suddenly project much higher profits because of a mid-year boom, well, increasing your future estimated payments will help prevent a large penalty at year-end. Conversely, if profits slump unexpectedly, lowering your future payments prevents tying up much-needed capital with the IRS when you could really use it.
So adjust as you go based on reality.
Precisely. And here's a crucial tactical maneuver related to that. If an underpayment has already occurred, maybe because of that change in estimate or a missed deposit or even just a simple calculation mistake, an immediate catch-up payment should be made as soon as possible. As soon as you realize the shortfall, this isn't just about, good intentions. Making that catch-up payment directly reduces the amount of any resulting underpayment penalty, because the penalty, remember, is calculated based on how long the underpayment existed. By paying early, even if it's technically late for the initial installment, you shorten that penalty period.
Okay. Damage control.
Exactly.
Yeah.
It's a key proactive strategy to mitigate potential penalties and keep your tax payments aligned with your actual financial performance. It shows diligence even when your initial forecasts went a bit sideways.
Okay, that makes sense. Adjust and catch up quickly if needed. Now, this brings us to some really fascinating methods you mentioned, designed for businesses with fluctuating income. What about those companies with highly seasonal income? The classic examples: a ski shop making all its money in winter, or an amusement park thriving only in the summer months. Do they really have to estimate based on an even quarterly income flow? Because that clearly wouldn't match their reality at all. Seems incredibly inefficient for cash flow.
That's precisely the challenge these methods are designed to address. And they represent some of the most significant opportunities for cash flow optimization, especially for businesses with those nonlinear revenue streams. The first one is the annualized income installment method. This method is specifically designed for businesses whose income is expected to vary significantly during the year. Think seasonal operations, project-based work, unpredictable sales cycles, that sort of thing. The key benefit here, it allows the corporation to lower the amount of one or more required installments during their periods of low income. It doesn't force them to pay as if income were flowing in evenly throughout the year.
Okay, lower payments during the slow times. How does that actually work mechanically?
Well, you essentially take your income earned for a shorter period, say the first 3 months for the first installment due in April. You divide that income by the number of months in that period, 3, and then you multiply that result by 12. That gives you a projected full-year income based on that shorter period. This projection allows businesses with fluctuating revenue to pay estimated taxes based on their actual performance up to that point, rather than just a flat, potentially inaccurate initial guess for the whole year. Think about that ski shop again. Using this method, they don't have to pay hefty quarterly estimates in the spring or summer when their income is minimal or non-existent.
Right.
Instead, they can pay estimated taxes based on their actual, maybe very low income earned in those months. This lets them hold on to their capital when they need it most, maybe for off-season maintenance or planning. They only need to catch up with larger payments when their peak season arrives and the cash is actually flowing in.
That sounds incredibly useful for seasonal businesses. Are there any catches or specific rules for using it?
There's one crucial rule to remember. If you use Schedule A, that's the specific IRS form where you do these calculations for any payment date using this annualized method, then you must use Schedule A for all payment due dates throughout that entire tax year. You can't sort of cherry pick. You can't annualize for Q1 and Q2, then switch back to regular estimates for Q3 and Q4. It's an all or nothing election for the year. Consistency is key.
Consistency is key for the year, yes. And the beauty of Schedule A is that when you complete it properly, it automatically compares the annualized income installment amount, the adjusted seasonal installment amount, which we'll talk about next if you qualify, and the regular installment amount based on your overall estimate. It then selects the smallest of those amounts for that specific payment period. It has built-in optimization, ensuring you're always paying the minimum required amount based on the methods available to you. And there's one more important timing caution in the instructions. Do not figure any required installment until after the end of the month preceding the due date for that installment.
Okay, why is that? It ensures that your annualization calculation is based on the most recent, accurate income data available. You're reflecting your most up-to-date financial picture right before the payment is due, not guessing based on older data.
Got it. Use the latest numbers. So you mentioned an adjusted seasonal installment method too. How is that different?
Right. That's the second major method for fluctuating income, specifically found in Part 1 of that same Schedule A. The adjusted seasonal installment method has a much stricter qualification threshold. But for those businesses that meet it, it offers potentially even greater flexibility. A corporation can use this method only if its base period percentage for any specific 6 consecutive month period within the tax year equals or exceeds 70%. That's 1.70. Basically, it means a very significant concentrated portion of their taxable income consistently comes in during that specific 6-month window, year after year.
70% in 6 months. Okay, how do you calculate that base period percentage? Sounds a bit technical.
It is a bit technical, but logical. You calculate it by looking at the average of 3 percentages. For the 6-month period you're testing, say May through October, you look at your taxable income for that same period in each of the 3 immediately preceding tax years. For each of those 3 prior years, you calculate the percentage of that 6-month period's income relative to the total taxable income for that entire year. Then you average those 3 percentages together. If that average is 70% or more, you qualify for the adjusted seasonal method. It's about demonstrating a really consistent, strong seasonal pattern over the last 3 years.
Okay, an average over 3 years. Can you give an example, maybe back to the amusement park?
Absolutely. The amusement park is a perfect example, just like the one the IRS uses in the instructions. Let's say our amusement park has a calendar year as its tax year, and it normally gets the vast majority of its taxable income during the 6-month period from May through October. Makes sense, right? Summer season. To compute its base period percentage for this May-October period, looking ahead to, say, 2024, the park would need to look back at its income figures for May-October in 2021, 2022, and 2023. Let's imagine the results were. For May-October 2021, that period accounted for 69% of the total income for 2021. For May-October 2022, maybe it was 74%. And for May-October 2023, perhaps 67%. Now, you average those 3 percentages, 69 plus 74 plus 67 divided by 3, that comes out to exactly 70%.
Bang on the threshold.
Exactly. Since that average meets the 70% threshold, our amusement park qualifies for the adjusted seasonal installment method. What does this mean for them? It allows them to significantly reduce their estimated tax payments during their off-season months, say Q1 and Q4. They can match their payments much more closely to their actual cash inflows. This prevents large overpayments that would otherwise just tie up crucial capital during their lean months when they need it for maintenance, planning, maybe preseason hiring. It's a classic example of tax optimization, aligning your tax payments with your actual business cycles, which enables much greater financial agility.
That makes perfect sense for truly seasonal businesses.
Yeah.
A really powerful tool if you qualify. Okay, so we've covered methods for fluctuating income. Now, what about larger corporations? You mentioned they have different rules. Do they get additional strategies, or are the rules just different, maybe stricter, considering their potentially more complex finances and higher tax bills?
Yeah, large corporations do indeed operate under a distinct set of rules for their estimated tax payments. These are specifically laid out around line 11 of that Form 1120W worksheet. First, what is a large corporation in this context? The IRS defines it as a corporation that had, or whose predecessor corporation had, taxable income of $1 million or more for any of the 3 tax years immediately preceding the current tax year.
1 million in taxable income in any of the last 3 years.
Correct. If the corporation hasn't been around for 3 years yet, then it's based on the number of years it has existed. And there's a slight nuance here. For this specific definition, taxable income is modified slightly. You exclude any net operating loss, NOL, and capital loss carrybacks or carryovers. So it's really focused on your core operational profitability in those preceding years.
Okay, so if you hit that $1 million mark in recent history, you're large. How does that change the payment strategy?
The strategic payment structure for these large corporations differs, and it depends on a key comparison. Is their current year's expected tax liability likely to be larger or smaller than their prior year's actual tax? Let's take the simpler case first. If the current year's expected tax, that's line 8 on the worksheet, is smaller than the prior year's actual tax, line 9A, then the large corporation simply enters 25% of the current year's expected tax in all 4 installment columns on the worksheet. It's straightforward. It reflects a more stable or perhaps declining tax liability situation. The focus is on paying based on the current lower expectation.
Okay, simple enough if taxes are going down or staying flat. What if they're going up? If the prior year tax was smaller than this year's expected tax?
Right. This is where it gets more complex and honestly offers a very specific kind of cash flow management dynamic dictated by the rules. If the prior year's tax, line 9A, is smaller than the current year's expected tax, line 8, which indicates growth, right? Higher profits expected this year, then the payment structure shifts significantly. Think of it like the IRS wanting to get a share of that increased profit a bit sooner. For the first installment, the one typically due in April, column A, the large corporation still gets to pay 25% of the prior year's tax amount.
Okay, based on the lower prior year for the first payment.
Exactly. This allows for a potentially lower initial payment, giving the business maybe a little more breathing room early in the year while those current year income figures are still solidifying. But for the second installment, the one usually due in June, column B, there's a significant catch-up payment baked into the calculation. The calculation is a bit intricate, but basically it involves figuring the difference between the current year's expected tax and the prior year's tax, and ensuring that by the end of the second payment, you've paid enough to cover a proportional share of the increase, plus the regular amount. This often means the second installment can be significantly larger than the first, sometimes much larger. It effectively front-loads a larger portion of the tax liability into that second payment when the business is experiencing significant growth compared to the prior year.
So a potentially big jump in the Q2 payment if profits are rising.
A potentially very big jump, yes. Then, for the third and fourth installments, column C and D, the payments generally revert back to being 25% of the current year's expected tax liability. The implication here is pretty profound for cash flow management for these large, growing companies. This rule pushes more of the tax liability into that second quarter payment. It means large corporations need to manage their cash flow proactively and forecast accurately to avoid a nasty surprise when that Q2 payment comes due. It's a calculated adjustment by the IRS to accelerate tax collection when corporate profits are on the rise.
That's a really important dynamic for large, growing companies to understand and plan for. Okay, you mentioned extraordinary items earlier when talking about annualization. Can we circle back to those? What exactly qualifies as extraordinary, and how do they actually factor into these calculations, especially when you're trying to optimize payments using methods like annualization? They sound like they could swing the numbers pretty dramatically.
That's a very astute observation, and yes, they absolutely can swing the numbers. Extraordinary items can have a really significant impact on your estimated tax calculations, particularly if you're using the annualized income method. Think of them maybe like a financial earthquake, something unusual, impactful, and definitely not part of your regular predictable revenue or expense forecast. The IRS defines several types of these items. Key examples include a large net operating loss, NOL carryover from a prior year, something called a Section 481A adjustment, which often comes up if there's a mandatory change in your accounting method required by the IRS, leading to a one-time income or deduction adjustment. Another big one is the net gain or loss from selling off a significant chunk of your business, specifically 25% or more of the fair market value of your business assets during the tax year, like selling off a major division or a huge piece of property. And then there are other items the IRS might specifically designate as extraordinary in official guidance, like the Internal Revenue Bulletin. These are generally one-off or non-recurring events that could really distort your regular income pattern if you didn't treat them separately.
Okay, so big unusual events. How are they treated when you're trying to figure out your annualized income for estimated tax?
The general rule for how you treat these in the annualization calculation is that these extraordinary items are taken into account after you've already annualized your regular recurring taxable income for that period. Step 1, annualize your normal operational income. Step 2, then factor in these extraordinary items. This helps prevent a single large unusual event from disproportionately skewing your estimated tax payments for the entire year based on just one annualization period. It smooths things out a bit. There's also a special timing rule for a couple of these, specifically a net operating loss deduction and that Section 481A adjustment. They are generally treated as occurring on the very first day of the tax year in which the item is taken into account for taxable income.
First day of the year, even if the event happens later.
Generally, yes, for these specific items when figuring estimated tax acts, this can influence which installment period they impact most heavily, often making them applicable right from the first payment, pushing their effect earlier in the year.
Interesting. Is there any flexibility there?
There is a little bit, yes. There's a useful de minimis rule here. If an extraordinary item other than an NOL carryover or a Section 481 adjustment, those always get the special treatment, results from a transaction where the total extraordinary items involved are less than $1 million, then the corporation actually have a choice. They can either choose to annualize these smaller extraordinary items right along with their regular income using the general annualization rules, or they can stick to the standard method and take them into account after annualizing their regular taxable income for the period. This provides a small but potentially important bit of strategic flexibility. It lets you manage how these smaller but still maybe significant unusual items impact your quarterly estimates. You could potentially smooth out what might otherwise be a lumpy payment caused by a smaller one-off event, giving you a bit more control over your cash flow timing.
Okay, that's good to know about the under $1 million flexibility. Now, what about income from controlled foreign corporations? CFCs, that seems like a really specific and probably pretty complex area of international tax. How does that kind of income factor into the estimated tax payments for the U.S. parent corporation, especially given how volatile that income might be?
You're absolutely right. It is a very specific and often quite complex area that many multinational corporations have to grapple with. For income, that's includable under Section 951A, which broadly covers certain types of income earned by these controlled foreign corporations, CFCs. The general rule when you're figuring your annualized income installments for estimated tax is that this income must be taken into account pretty much as it's earned by the CFC.
As it's earned abroad. Essentially, yes. If your CFC earns a significant chunk of its income in, say, Q1, that income generally needs to be reflected in the U.S. parent's Q1 estimated tax calculation using the annualized method. This is consistent with the overall idea of matching estimated payments to when income is actually realized by the consolidated group, similar in principle to how partnership income inclusions are handled for a partner's estimated taxes. But as you hinted, this can be really challenging because CFC income can be highly unpredictable. It's subject to foreign market fluctuations, exchange rate swings, various international business factors. It can be tough to estimate accurately in real time.
So it sounds like it could lead to big swings in estimated payments or potential underpayments if you guess wrong. Is there anything to help with that uncertainty? There is, and this is a fantastic, I'd say, tax optimizing feature, or maybe certainty providing feature, related specifically to this CFC income. It's the Safe Harbor election. This election is designed specifically to help corporations manage that inherent volatility and uncertainty around CFC income. It helps prevent potential overpayment headaches or significant underpayment penalties when dealing with hard-to-predict foreign earnings. Under this election, an eligible U.S. corporation can choose to be treated as having received items of income under Section 951A, ratably meaning evenly throughout the tax year. And the amount they're treated as receiving is equal to 115% of the actual Section 951A amounts shown on the corporation's tax return for the first preceding tax year.
Okay, so based on last year's number, plus 15%.
Exactly. Based on a known historical number, with a bit of an upward buffer. Now, if you happen to be a non-controlling shareholder in the CFC, that percentage drops to just 100% of the prior year's amount, offering a simpler baseline in that case. And there's another layer. For calculating your first and second required installments of the current year using this safe harbor, you actually base it on the amounts from the second preceding tax year. This gives you an even earlier, more stable benchmark to use when those first crucial payments are due.
Wow. So you get predictability instead of trying to guess this year's potentially wild CSE income.
That's the significant benefit, precisely. It allows for much better, much more predictable cash flow planning. Instead of trying to accurately estimate potentially fluctuating or highly uncertain CFC income for the current year, which, let's face it, can be a difficult and time-consuming exercise involving foreign operations, you can rely on a known prior year figure, adjusted slightly upward. This provides a clear, predictable baseline for your estimated payments related to that CFC income. Think about it. If your actual CFC income for the current year ends up being lower than the 115% or 100% amount you've paid based on the safe harbor, well, you've avoided overpaying significantly during the year. You might get a refund later or just future payments. Conversely, if your actual CFC income ends up being higher, you might have a larger catch-up payment due later in the year or when you file, but you've avoided tying up excessive capital early on based on uncertain projections. It's a really strategic way to manage that international tax uncertainty, prevent tying up capital unnecessarily, and smooth out your tax obligations based on historical, quantifiable data rather than potentially speculative forecasts. A company treasurer might really value this predictability.
That CFC safe harbor sounds like a really valuable tool for multinationals. Okay, wrapping up the calculation components. How do other taxes and various tax credits fit into all this? They must influence the total amount due somehow, right? Do they always reduce the estimated tax liability, or can some things actually increase it?
They absolutely do influence the total, and it's a critical part of getting the final calculation right. It's definitely not just about your taxable income from regular operations. Tax credits, as you'd probably expect, generally work to directly reduce your estimated tax liability. They act as a direct dollar-for-dollar offset against the tax you owe for that period. For instance, credits like those for federal tax paid on fuels, you'd look at Form 4136 for that, or other refundable credits, maybe even credit for tax paid on ozone-depleting chemicals. These are all applied to lower the amount of estimated tax you need to pay. You typically find more details on these potentially applicable credits on Schedule J of the main Form 1120. These credits are essentially incentives or compensations that directly lessen your tax burden, which means less cash outflow needed for your estimated payments. Always a welcome relief for cash flow.
Okay, credits reduce the payment. What about things that increase it?
Right. Conversely, certain other taxes will increase your estimated tax liability. They add to the total amount you need to factor into your installment payments. These are often obligations that aren't necessarily tied directly to your regular operating income for the year. A big example for certain large multinational corporations is the Base Erosion Minimum Tax Amount, often called BEAT. This isn't directly tied to your U.S. operating income. It relates more to specific types of payments made to foreign affiliates. For a large corporation subject to BEAT, suddenly having this additional layer of tax can drastically alter their required estimated payments. It requires careful forecasting that goes beyond just their expected U.S. profits. Similarly, any recaptured tax credits from previous years would also increase your current estimated tax liability. For example, maybe you claimed an investment credit a few years ago, but then disposed of the property early, triggering a recapture. That recaptured back gets added back into the tax you owe now, and thus needs to be included in your current estimated payments. So yeah, it's not just income and deductions that matter. You have to meticulously factor in these applicable credits, which reduce the tax, and these other specific taxes or recaptures, which increase it, to arrive at the correct estimated payment amount.
It really highlights the need for comprehensive tax planning, not just looking at operational profit. Okay, one last strategic decision I noticed in the materials, something about choosing different annualization periods. How does that work, and why would a corporation choose one option over another? This sounds like yet another layer of potential optimization.
It is indeed another potentially powerful layer of strategic flexibility, but specifically for those businesses that both qualify for and choose to use the annualized income installment method we discussed earlier. Remember, when you're annualizing, you're essentially projecting your full year's income based on shorter, actual periods of performance. The standard approach outlined by the IRS uses fixed annualization periods for the 4 installments. For a typical calendar year corporation, those standard periods are based on the first 3 months, then the first 3 months again, effectively, then the first 6 months, and finally the first 9 months of the year. However, the IRS also offers Option 1 and Option 2 for choosing different annualization periods. These are detailed in Part 2, line 20 of Schedule A. They give businesses potentially more tailored choices. For example, Option 1 uses annualization periods based on the first 2 months, then the first 4 months, then the first 7 months, and finally the first 10 months for the respective installments. Option 2 uses periods of 3, 5, 8, and 11 months.
Okay, different sets of months to base the projection on. Why would you pick one over the others? What's the strategy?
The choice of which set of annualization periods to use, standard, Option 1, or Option 2, can be highly strategic. It directly affects how quickly your income earned early in the year gets projected over the full year, and therefore how much estimated tax you might owe in those crucial earlier installments. A corporation might choose a different option based on their very specific anticipated income patterns throughout that particular year. For instance, imagine a business expects a very strong start to the year, maybe huge sales in January and February, but then they anticipate things leveling off. Using Option 1, which has that short 2-month period for the first installment, might result in a lower first payment compared to the standard 3-month period because it annualizes less of that initial high income. Conversely, if income is expected to be heavily weighted towards the very end of the year, maybe a giant project completion payment landing in December. Choosing an option with shorter early periods could mean significantly lower initial payments throughout most of the year. This allows the business to retain more cash until that major revenue event actually occurs near year-end. It's all about trying to fine-tune your tax payment schedule to better match your predicted cash inflows for that specific year.
That sounds like it could be really beneficial if you have a good forecast. Is there a catch to using Option 1 or 2?
There is a very important procedural catch and a consequence. If a corporation wants to use either Option 1 or Option 2, they must file Form 8842, which is the election to use different annualization periods for corporate estimated tax. And critically, they have to file this form on or before the due date of the very first required installment payment for that tax year.
The first payment due date, so really early in the year.
Exactly, usually April 15th for calendar year core. This means you have to make this strategic decision very early on, often before your full year income picture was entirely clear. It makes it a significant upfront commitment based on your forecast. And here's the consequence. Once you make that election by filing Form 8842, it is irrevocable for that particular tax year. You are locked into using those chosen annualization periods, Option 1 or Option 2, for all 4 installments that year. You can't switch back mid-year.
Wow, okay. Irrevocable.
It's irrevocable for the year. So careful forecasting and probably a good discussion with your tax professional are absolutely essential before deciding to make this election. It's definitely a powerful tool for cash flow timing optimization, but it demands real foresight and a solid understanding of your business's projected financial performance for the year ahead.
Okay, so what does this all mean for our listener? We have covered a ton of detail here, from the basic requirements, who, when, how much, to these really advanced strategies like annualization, the seasonal method, those specific rules for large corporations, safe harbors for tricky income streams like CFCs. How does someone, the business owner, the CFO, pull all of this together to make truly smart, optimized financial decisions for their business? It feels like a lot to juggle.
It can feel like a lot, absolutely. But I think the key is to remember what that IRS Form 1120W actually is. It isn't just some compliance form you fill out grudgingly at the last minute. It's designed to be a worksheet. Think of it as a powerful analytical tool. It's there to aid you in determining your estimated tax liability with precision and ideally with foresight. Notice how it directly references lines from your main Form 1120, the U.S. Corporation Income Tax Return. It constantly links your current estimated payments back to your eventual final tax liability. It serves as a kind of living projection throughout the year, not just a static one-time calculation.
So view the worksheet as a tool, not just a form.
Exactly. And a critical starting point always for any corporation figuring its estimates is to look at your prior year's tax. That's what you'll enter on line 9A of the 1120W. This isn't just historical data, it's often the baseline for your current year's estimates. And, as we discussed, it's crucial for determining if you even qualify as a large corporation with those distinct payment rules. And don't forget about prior year overpayments. If you had an overpayment last year and chose to credit it against this year's tax, that's critical. That amount acts as a direct payment against your unpaid required installments for this year, immediately reducing your immediate cash outlay. Which, again, highlights why that quick refund opportunity, Form 4466, is so vital. It gives you the choice whether to take that cash back quickly or apply it strategically to future tax needs.
Right, connecting the prior year to the current year planning.
Precisely. And of course, for those businesses with that fluctuating or seasonal income we spent time on, Schedule A becomes absolutely indispensable. If you're using either the annualized or the adjusted seasonal installment methods, you must complete Schedule A accurately. The entire structure of Form 1120W, especially when you get down towards the end, like Part 3, Line 38, is designed to help you find the smallest legally required installment amount for each period. It guides you through comparing the different methods you might qualify for: regular, annualized, seasonal, and helps you select the most favorable outcome, the lowest payment required by law for that quarter. The overarching goal always should be to pay the minimum legally required amount at each installment due date. Doing that maximizes your business's available cash flow throughout the year while simultaneously helping you avoid those costly underpayment penalties. When you approach it that way, it really does turn what feels like a potential drain on resources into a strategic asset management process.
This really raises an important question then, doesn't it? In a world just saturated with information, true financial intelligence, it seems, isn't just about knowing what the rules are, but really understanding how to apply them strategically. And for corporate estimated taxes, it sounds like it's truly about transforming what feels like a necessary compliance task into an active cash flow management tool.
Exactly. That's the perfect way to put it. It shifts the perspective entirely.
So thinking about everything we've covered, what stands out to you from this deep dive? For the listener tuning in, could optimizing your estimated tax payments actually be that unexpected lever for financial agility you've been looking for? Maybe consider how a proactive approach, really armed with this kind of knowledge, can empower your business well beyond just meeting the basic obligations. How you can turn these complex IRS forms and rules into, well, a roadmap for smarter fiscal health for your company. Keep exploring these details, keep questioning how they apply to you, and keep digging deep into what truly makes your business thrive. We'll be here with the next deep dive.